Dear viewers, welcome to yet another edition of Expert Speaks. This week, we are introducing a quarterly feature, a feature where you can know about what happened in the Indian equities in the quarter gone by and how equities might perform going forward. This is a special feature where my popular faculty, fund manager Harini Dedia, is going to brief to the audience performance of the Indian equity market. This is NRI Money Clinic for you, and I am Dr. Chandrakant, your financial guide for a happy living.
NRI Money Clinic. No hype, just the right advice.
Dear viewers, to take you through the Indian equity scorecard, how it looks like in a rear view mirror and how does the road look ahead, fund manager Harini Dedia is going to talk to the audience with all the data points today. Harini Dedia is head of research and a fund manager at Tamohara Investment Managers, a boutique PMS fund. Harini is a chartered financial analyst. She is a BA honors with politics, economics, and mathematical advanced models as her study subject. She started her career in New York working with a hedge fund. She started her career when she moved back to India to Galla Bansali stockbrokers. Currently, she is handling funds in excess of 300 crores. Who can be better than the ACE fund manager and an analyst par excellence, Harini Dedia? Welcome to the show, Harini Dedia.
Thank you so much, Dr. Bhatt, for that very kind introduction again.
Harini, I request you to come on my show every quarter and take you through the scorecard of Indian equities. What did you see in the quarter gone by where you have the published result? And what's happening at the sectoral level? What did you observe? Is it looking good, great, or you are looking at the opportunities or the roadblocks? How does the road look like? I would like to hear from you. Can you take us through the data points for the benefit of our audience? It's all over to you now.
Thank you so much, Dr. Bhatt, for that very kind introduction. And it would be an absolute honor for me to come to your channel on a quarterly basis to present my views on what has happened in the quarter gone by and what we see as potential opportunities in the Indian equity markets going ahead. I think it is almost befitting to start this review where we left off a previous episode on NRI Money Clinics, which was a discussion on Indian equities versus the rest of the world. We had spoken about India being one of those rare markets in the world which has consistently delivered a dollar return of over 7%. And if you see, there are only two other equity markets that have done so in the past for every single decade, right? That is Denmark, US, and India. So you do have countries like Finland, for example, which looks very attractive from a 30-year perspective. But if you see, the consistency has not followed through in the last 5 years or in the last 10 years or the last 20 years. So it was basically the moment when Nokia became a big company that a country like Finland saw a significantly higher return. But since then, it has been pretty flat. For the last 20-year returns are actually 1.5% CAGR. So the point I'm trying to make here is that India is one of those rare equity markets that consistently for the last 3 decades and every decade and every time frame of 5 to 7 years has delivered this 7% odd dollar returns on an aggregate basis. And this return has come on the basis of a earnings per share growth of 8.2% in dollar terms, right? So it is not a return, contrary to popular belief, that has come only with valuation multiples going up. It has come on the back of earnings per share going up. So diving right into the review, I think an argument that is being made across the board right now is that Indian equity markets are expensive. And this is something that we wanted to debunk a little bit because, yes, they're expensive. We're not saying that they're absolutely cheap markets to invest in, but Indian equity markets, because of their consistency and because of the longevity of the growth that they offer, are likely to remain at a premium to the rest of the world markets. So while we might see a little bit of time correction still, so if rest of the world seems to recover from recessionary fears, India would likely underperform global equities. But that is not to say that we expect a significant price correction from here onward. So when we look at the earnings for the Indian market, this year has been quite soft compared to what we saw in the last two financial years, where we had explosive 19% followed by 34% growth in the earnings per share for the Nifty 50, which is the benchmark index for India. This year has been soft because of inflationary-led pressures on the margins. So we are likely to see only a 10% odd growth in the earnings for Nifty 50. However, we believe that this inflationary pressures have to a certain degree eased. Where they have not, we will see a little more easing in the next couple of quarters, and margins will return to normal in FY24. So if I was to zoom out and give you an outlook for the next financial year as well, currently, I would say that if FY23 has been a year of margin compression, return to normal, return to mean will suggest that FY24 would also mean margin expansion on a year-on-year basis. And we are expecting commensurate growth in the earnings for Nifty 50 over the next financial year. But when we look into the earnings of the last quarter that was reported by Indian companies, we see a lot of pain, right? Because the sales growth has come in at 26%. That is helped by inflation. When you have inflation, you also have price hikes that a company is able to take. And that is why it's a value-led growth. It is not predominantly a volume-led growth in the sales part of things, which is evident in the EBITDA growth that these companies have reported, where they've seen margin pressures come in. So if your raw material pricing has gone up by 100, they've probably taken a price hike of, let's say, 70, but the 30 remainder has to be absorbed by the companies themselves, which has resulted in margin compression. So we have inflation-led sales growth, but also inflation causing margin compression, and PAT growth of degrowth of 9%, in fact. If we were to remove banking, which was the best sector in terms of earnings for the last quarter, the PAT growth for the remainder of the economy looks even weaker. The one other sector that we do want to highlight over here is pharma results were not as bad as they were made out to be. Pharma has seen a sales growth of 7.5%, EBITDA growth of 18.5%, and a PAT growth of 20.5%. So there is a certain amount of returning to normalization that we are observing in the pharma space currently. And this is a very zoomed in picture of what we saw happen in the earnings in the previous quarter. In our proprietary stock scoring system, we've seen the average score for a company fall by about 10% in this quarter versus the previous quarter. And that itself tells us that the margin pressures have also come with cash flow cycles getting elongated again. So there is working capital pressure as well. So in the near term, things are not as sanguine as people might make them out to be. But in the medium term, we believe that the trajectory for FY24 is set, and we should have a good year in terms of earnings growth in FY24. When we look at what the sectors have reported in September, we see three sectors really stand out. One is IT. Why I say IT has stood out is because results were not expected to be good in this sector. IT sector of India, the IT services sector, is exposed to Europe and US based demand. As we know, demand over there has softened, which would result in IT companies in India facing the brunt of it. However, this time around, we've seen that the hit on demand has not been as expected. And on the other side, with startup funding in India getting a little tighter, we've seen the kind of job attrition that we used to see from tech companies has calmed down. A lot many more people now looking to get employed with MNCs or the big IT companies of India, rather than looking to work at startups. For there have been far too many cases of layoffs that we've heard in the previous 9 to 10 months now in the Indian startup space. So in IT, we had a case where European demand was not as severely hit as expected. We have a case where supply side pressures eased off, and valuations had also corrected significantly from where they were last year. So the IT sector to that extent surprised us. The reason I've not put banking in this review is banking results were expected to be good and they came out to be good. The other segment, like we highlighted, is the pharma and healthcare space, where results came in better than expected. US FDA visits have started again, and though most people fear that this would mean a lot of regulatory hurdles, remember one thing, that when the regulator comes by, he or she does not only come by with an intention to stop, but also with an intention to approve as many new generic products as they possibly can. So when the US FDA regulatory visits have started, it also means that new approvals for Indian companies would start coming through, which were very slow during the COVID years of 2021 and first half of 22. We believe that pains that are being witnessed by the European manufacturing sector, which is another alternative for pharma giants to look at when they're looking at their sourcing or contract manufacturing their products from, that seeing a lot of pains due to higher power costs will lead to incremental inquiries and demand coming to certain Indian companies as well. So pharma sector, we saw reported decent numbers in the September quarter. And the other avenue where we saw numbers being slightly better than expectations was infra and infra ancillaries. So capital goods, again, we are not highlighting currently because capital goods, the numbers were expected to be good and they came out to be good. But infra and infra ancillaries was one area where people hadn't expected anything really, given they're still burned by what has happened in this sector in the last decade or so. But we've seen order books go up for infra companies, execution also pick up. And remember, September quarter is a monsoon quarter in India. So typically execution is on the lower end. Despite that, we've seen execution for most companies be ahead of what even a normal quarter would be like, a non-monsoon quarter would be like in some cases. So this is something that was interesting for us to know. When we now go ahead and see what are we expecting from different sectors in the next quarter or 2 quarters, I think one thing that we expect is in the financial space or the banking BFSI space, we're expecting the Goldilocks period to come to an end probably in a quarter or two. What we've seen is probably the best year for banking in a long, long time in India. And we believe that we will still have a quarter or two of great results, but credit costs will normalize from here on. We had banks recognize NPAs across the board and start this year with a very, very clean slate. So they were able to report very low and minimal credit costs that we believe will return to normal. And we believe that the margins that the banks have enjoyed will also come back to normal as their borrowing costs have also started to inch up. So we think that FY24, we would be trimming our positions in the banking and financial space. The second sector where we're expecting good results to continue is pharma and healthcare. But here we believe that valuations are actually in our favor. Valuations are trending, in fact, below their 5-year average. And we think that people have not really understood the longevity of this earnings that is coming around this time in the pharma space. We think that the pricing pressure that a lot of Indian giants complain about in the US generic space will also ease off. Or is already easing off. So we think that our take on this would be slightly different than it is on the financial sector. We would want to add to our positions in the pharma and healthcare space. And the third sector that we would want to spotlight for the next quarter and quarters going ahead is infra and ancillary companies. One thing to remember over here is we are going to head into elections in 2024, and infra spends in the year before elections typically keep and maintain a healthy pace. It is the unfortunate reality that these things get timed with elections as well in our country, or in any democracy for that matter. But if we can take advantage of that, nothing better than that for us. So we believe that tendering activity that has started picking up will continue to sustain its momentum. Thanks to PLI scheme and thanks to the corporate tax cuts, the private capex has gathered steam, that the government will match the pace in the infrastructure spend, because private players are only going to do capex in terms of putting up a factory, but to provide roads or waterways for logistics purposes, or to provide adequate power supply to those factories, these are all kinds of capex that the government would have to keep up pace with, so that the private players are actually able to fructify their investments that they are making currently. The leverage position currently for the central government and private players is at a very comfortable level. So we believe that all of this put together provides us a good runway for the infra companies in the next quarter to few quarters ahead as well. One simple thing that we wanted to highlight over here is we currently do not have a preference for road companies. So road has been that one segment in India infrastructure that has done exceedingly well in the last 5 to 6 years. Going forward, in the infrastructure space, we are looking at everything barring road companies, because we believe that there is going to be a ceiling hit in terms of tendering activity over here. And there's going to be a ceiling in terms of cash flow generation with the new equity norms that are coming up for road EPC players. So this is our take on what we expect going forward. Quickly, if I can just show you a few data points of why we are confident on pharma and infra. If you see the trend for pharma, even as recent as November 2022, there has been a 17.5% growth in value terms, which is supported by a 9% growth in volume terms. So this is a sector that is, at least the domestic pharma players are growing faster than India's nominal GDP, and volume is growing faster than India's real GDP. So this is a place where we see growth shifting to, and we would want to be a part of that. As highlighted, we've seen the pressure on American generic sales, Indian companies' American generic sales ease off. So we are seeing normalization of price erosion. So we had seen double-digit price erosion in the US markets, and that has now come down to mid-single digits to low single digits, depending on the molecules. And on infra, this is essentially what we were referring to, that the last 5 years, tendering activity was pretty much at a constant pace. I would ignore FY20 and 21 numbers because they were a bit impacted by COVID. But across the board, otherwise, we have seen a 75,000 crore tendering pace in the infra space. And that has now finally gone over 1 lakh crore in terms of tendering activity. And we believe this is being followed up today with awarding activities as well, as is evident from all the EPC companies' order book as well. So we think it's a good time to spend a lot of our research hours into this space. We recognize that this space has seen a lot many more accidents in the past. So we're extremely careful on understanding the cash flows of the company before investing here. And we still think that the mistakes and the failures of the past should not hinder us from recognizing that there is an attractively priced opportunity here. So this is my review for the quarter that is gone by. With this, I would hand back the floor to Dr. Bhatt.
Dear viewers, this is going to be a quarterly feature where we will bring to you the India scorecard. I would like to hear from you. What would you like to hear from us in this particular review of Indian equities in the last quarter? If you have any specific suggestion, if you have some specific request, if you would like to hear on specific things, please do share your thought in the comment section below. We are listening to you. Harini, thank you very much for your time and the amount of research that you have done for the benefit of our audience. I remain in gratitude to you for your kindness to come all over and share all these inputs, which otherwise is reserved for your exclusive clientele. We remain in gratitude to you. Thank you very much.
Thank you so much. It's an honor to be on your channel, sir.
Dear viewers, hope the video that we have done today helped you to understand what's happening in the Indian equity markets, what is changing, where are the opportunities, where are the threats, what are the changing trends. If it did help you to understand all this, do like this video. If you are a person who is watching my channel for the first time, or if you are yet to subscribe to the channel, please hit the subscribe button and press the bell icon. Don't forget to share these videos with your near and dear ones. Thank you very much for watching this episode on NRI Money Clinic. I shall be back with you next Tuesday with yet another expert, yet another topic. Till then, stay safe.
Press the bell icon for more details and subscribe our channel.